So Foreign Colonial was launched in 1868, and when it was originally launched, it was set up for the investor of moderate means, and that ethos is still very much in evidence today. We have over 100,000 individual investors, the overwhelming portion of which are retail, but the portfolio has changed really quite markedly over the decades. So when we launched with 18 bonds, overseas, invested in overseas markets. And over the years, we've changed our investment universe, firstly to include corporate bonds, then into equities in the 1920s. And in more recent decades, we've moved exclusively into investments in listed equity and private equity. So the overriding objective of the trust is to deliver long-term growth in capital and income. And today that leads us towards growth assets, that's listed equity and private equity. And we run the portfolio using a range of different investment strategies. So for example, we invest into a UK equity strategy, a US growth strategy, and so on. And these strategies are blended together. They're each designed to do something slightly different on the portfolio, typically run in a focused portfolio, but we run with the principle whereby returns are additive but risk is not. So this principle of diversification we started with 150 years ago, still very much relevant today, but for listed equities and private equity. So my role is to oversee management of the trust on a day-to-day basis. I am responsible for selection of the underlying strategies which we invest into, and also management of those strategies. So management of the strategies from a style perspective, different approaches that we employ, but also geographically. So I take responsibility for the overall asset allocation and positioning of the trust's investments. So a closed-ended fund, such as an investment trust, has several advantages. First, because it's closed-ended, we don't have to deal with inflows and outflows that open-ended products do. And that enables us to take a long-term approach in terms of investment perspective. And that's valuable in the context of long-termism and taking advantage of illiquidity as well. So that means that we can lock up capital to less liquid opportunities like private equity or unlisted investments, which should, in our view, give rise to an excess return over listed opportunities. The second area where we have an advantage is in gearing. We can, as a company, borrow, and today our average blended borrowing rate is only around 2.5%. We've got debt that goes out beyond 2030. So we've got a range of borrowings over a range of maturities. And if we can earn an excess return over our cost of borrowing, which is low, as I said, then that will generate value for shareholders. The other area where we have an advantage is in the ability to smooth dividends. So in the good times, we can put aside some of that revenue that we earn from our investments. And when times are perhaps less favourable, we can draw down from the reserves that we've built up in order to smooth dividends for shareholders. And that's enabled us, or helped to enable us, to pay dividends in each and every single year since we were launched, since 1868, and a rising dividend every year since 1970. So the board are independent directors of the company. They are responsible for overseeing service providers to that company, and the manager is the most important service provider to the trust. So they oversee the overall performance delivery and set the strategy for the company. So stock markets have had a very good run, performance has been very strong, and shareholders have clearly benefited from strong performance in listed markets and unlisted investments that we hold. I think a lot of that performance, certainly in recent years, has been delivered by good fundamentals. What I mean by that is that corporate earnings growth has been strong, and that's supported markets. At the present time, the outlook for the global economy looks good. We've got a synchronized upturn globally. We're no longer just reliant on the US economy. That's likely to lead to further improvement in earnings, which is very important for equity markets. But the flip side of that clearly is that inflation is beginning to rise modestly and central bank policy is beginning to tighten. And markets have been supported clearly by a very stimulative policy from central banks, and that's supported valuations. And markets no longer look cheap. So clearly valuations perhaps less attractive than they were, but fundamentals still reasonably robust. Our view is that the US economic cycle is likely to extend out into 2019, and the global backdrop is good. And we should expect rising volatility. We've seen some of that already in 2018, but perhaps a choppier performance from equity markets from here, but still, in our view, some upside for investors is likely.